Good morning to all. Today we are going to discuss about the contemporary trends and issues related to central banking. So far, we have discussed about many aspects of the central banking. I think during the last session, we discussed about the monetary policy fronts of different leading central banks around the world. And we saw at the same time, we touched about some unconventional monetary policies as well. So today our focus is on the recent trends and issues relating to the central bank. So with the pandemic issue, I think that we have a very wide area to discuss, but with the limited time given that we cannot discuss all the monetary policy measures or any other type of economic policies attended by the central banks around the world, but I have given focus on key central banks, that Fed Reserve banks and the European Central Bank in this discussion. If time permits, uh, I hope to discuss about some other central banks policy initiatives as well. So let's see what is the background of trends and issues. Basically, we can see that during the past 2 decades, at the global level, international trade and international financial markets are rapidly uh, change. Actually, they were developed in a very rapid speed. Here, I have mentioned that globally and even locally, the financial markets have grown larger, especially in the Western world. That means that developed countries that we can see both financial widening and the deepening. So the financial markets have grown larger, uh, both in the term of volumes traded and in terms of number of financial instruments. So now you can see that there is an impact for the central banks as well in formulating their monetary policy measures. In the 1970s and 80s, the world's capital markets were gradually deregulated. That means that the countries, they opened the capital mobility. So their capital markets started to expanded with the deregulations. That means that some measures have been introduced by the relevant authorities for the financial market entities to perform in a very free environment without very heavy regulated uh, background. This combined with the good global growth, that means that international trade, so that when the capital markets are integrated or the financial markets are expanding, means that it is again supportive to the international trade as well. So normally we can see that in developing countries that the trade openness is higher than the developed countries. But in the developed countries, their financial markets or the capital markets are more open than the developing countries. That is what we can basically see in general. However, these developments are facilitated by the information technology as well. So the information technology led to strong development on the global financial markets. We all know that it is very easy for us to do any transactions using the digital payment platforms and all today. So it is actually kind of a blessing for the developments of the financial markets. So with the help of this information technology or the digital technologies today, that financial markets are very comprehensive, as well as it is facilitating for further develop the overall financial system, the global system. So here it says that led to strong development on the global financial markets in terms of outstanding volumes. That means the amount of transaction, the total volume of transaction, as well as the turnover and new instrument. So we can see there are plenty of new instruments are there, and with the digital innovations, always they are getting updated. So there is no limit like that. The skies is the limit right now because of that rapid digital innovations. The development had major advantages. Yes, because of that financial markets they have developed. So it gives many advantages for the users. With less regulations, mean there is no such a very strict regulations. So financial sectors basic functions, as an example, executing payments, allocating savings to investment, mean that mobilizing of funds could be better managed. So at the same time, as the strong growth on the financial market contributed to the strong growth in the global economy. Always, when there is a very uh, uh, developed financial market, it's help mobilize funds. So normally savings to investment. So with that help, based on that, the economy can grow faster. So that's why it is very important for any country to have a very sound financial system. So already we discussed about uh, some aspects of the financial system at the time we discussed about the financial system stability. But a larger financial sector has also led to greater potential risk. Yeah, well known fact that there is a risk as well. So when the system is going to be very comprehensive means that potential risk also high. So as here exemplified by the financial crisis 12 years ago. So that fact is that because of that developments in the financial system, it's again was a reason for the financial crisis. So when we discuss about the economic developments before 12 years ago, that when compared with the current situation, that we can see there is a huge differences in between these two uh, times, right? Because of that greater potential risk, that always we have to have some measures to mitigate those potential risk as well. uh, or otherwise we have to expect financial crisis or the credit crunches as well. So this is what we have experienced during the last decades. Like, you know, for monetary policy, the changes in the financial markets have had an effect. So in that respect, to mitigate the potential risk, that being the regulator of the financial sector, so almost all the central bank around the world, they have a specific role to play. So we already discussed about that. But with the monetary policy as well, that there is an impact for the monetary policy as well, right? For the monetary policy, the changes in the financial markets have had an effect, as they have affected the channels and markets through which monetary policy measures act. Means that you remember, I hope that you remember about the transmission mechanism of the monetary policy that we discussed in earlier session. No, at the time that we discussed about the monetary policy of the Central Bank of Sri Lanka, we discussed about the monetary policy transmission, and under that topic that we discuss about different channels of uh, different channels of that transmission. Here again it's explained like that, because we know that when the central bank implement their monetary policies, that how it is going to be transmitted to the real sector. We know that it is transmitting through the financial markets. So when there are any changes in the financial markets, that we know that it affects that the impact of the monetary policy as well. because that monetary policy is transmitting through the financial market. When there is a changes in the financial market, it has an impact to the expected outcome of the monetary policy as well, right? Due to the economic, and the other thing is due to the economic integration in terms of trade and finance. Now here, so far we discussed about one individual economy, but when it comes to the global level, today we know that more almost all the countries are interlinked, right? So due to the economic integration in terms of the trade or finance, international trade or international finance, that we know that all the countries are now linked. There are so many links between the countries. So the economies are not independent today. So you know that, right? So we also heavily depend on, in terms of trade, that we are highly depend on China, and as well as on India. Like that, all the countries around the world, that we are highly depend on each other, right? Very recent example is, I hope that you have heard about that there is a big ship, the trade ship is stuck in the middle of the Suez Tunnel, so that many people, they predicted that it is going to be uh, impact on the overall price level of, that means that it gives inflation, because that many countries are depend on the import commodities, so that when that very big trade ship is going to be stuck in a separate place, so that it will give an impact on many economies around the world to raise general price levels. Likewise, that we can see how much the countries are now interdependent, right? So because of that uh, relationships in between those economies, global trends affect the economic performance of individual economies. That means that if something happen in an economy, right, at a particular corner of the world, but it has an direct or indirect impact to the other corner of the world, like today. So the global trends affect the economic performance of individual economies. So it is there. So basically, we know that when that the global price level, that in the world market, if the oil price increase, definitely it will give us. We are a very small open economy, but yet it gives us a inflation pressure. So because that we know that it is a kind of a input that we use for many things, right? So the fuel, so that it gives a very adverse impact to our economy as well. Likewise, that if something happen in a, especially in a major economies like USA, that we know that we have some not only the trade relationship, but the capital markets also have some links. So there is an impact. So associated with these links, the monetary policies among countries also have links with each other. So at the beginning, I said that if there is any change in the financial system or the economic system, accordingly, the monetary policy also need to be changed. So the monetary policy has to be adapted to that new environment. So because of that, all the economies are now today integrated, right? So we know that global trends are going to be affected at individual economics level. So because of that link, the monetary policies among the countries are also have some links, right? That's what it says. That as an example, in USA, if there is a higher inflation, that they have to implement a tightened monetary policy mechanism. So in the same way, our countries as well, that even the developing countries, that they have to adjust their monetary policies. Normally we can see that there is a kind of a relationship in between the monetary policies as well. But here one thing that we have to understand, but the same time, right? So under the same uh, global trends, sometimes that monetary policies not going to be the same, that they are not going to be uh, very similar to each other. It can be based basically on the conditions of the economic and financial environment. That means that the level of development of the real sector and the monetary sector, that these are the uh, fundamental fundamentals actually that decided what kind of a monetary policy to be implemented in a particular country. But yet we can see that there are some links in between the monetary policies among countries, right? So that then we have to discuss about the crisis and the instability. What is instability? You all know, because we have already discussed about the stability. So instability is the opposite of it, right? Where people cannot predict what will happen next, right? So always that crisis brings the instability in an economy. The world has experienced three unusually large crises over the past decade. Also can be added to some long-term structural and global changes. So when you sometimes you may have read or heard about the crisis situation that the world experienced during the last decades. We are going to discuss about some uh, uh, major crises. Over the 10 years ago, the global financial crisis started in the financial sector when the excessive risk taking that had built up over many years finally comes into a surface. That means it's happened in USA. Why it happened? Because uh, excessive risk taking that had built up over many years. That it is a credit boom the uh, that the banks, they have given credits, the mortgage for the mortgage. Uh, so many credits have been given for the consumers, right? That they are basically uh, to buy some real sector, the properties, right? Finally, uh, that credit boom was there and it collapsed the system. Shortly thereafter, the sovereign debt crisis broke out in Europe. That after that financial crisis, the the second one happened in the Europe. It is a sovereign debt crisis. Then the pandemic. We all know that it is very uh, known factor today, that it is considered as, now it is considered as it is a health crisis, but it gives many bad influences to the overall economic systems as well. So now it considered as a economic crisis as well, right? So that it is the current experience of many countries around the world. So it considered at the third crisis. It started as a health crisis and then it developed into a economic crisis because of that uh, uh, that we have to maintain distance, so many people that they cannot attend to their day-to-day economic activities. So that's how it become an economic crisis. The global financial crisis of 2008-2009 is widely referred to as the Great Recession. It is the financial crisis happened in 2008, during 2008-2009, and it referred to as the Great Recession. It begins with the housing market bubble. I already mentioned that, created by an overwhelming load of mortgage-backed securities, right? So that these securities that bundle high risk loans that based on that mortgage securities that the all banking sector that they started to give loans, that high risk loans, right? So that borrowers they were not able to pay back the loans, so that because of that non-performing loans, that bank had to face a very critical condition. So reckless lending led to unprecedented number of loans in default, so that most of the loans were get default. They were bundled together. The losses led many financial institutions to fail and require governmental bailout. So the government has to bail out those financial institutions by pumping money into the system or this financial institution, because they were all dry out of liquidity at that time. And then when we consider about the European sovereign debt crisis, uh, it was a period when several European countries experienced the collapse of financial institutions, basically because of the high government debt and rapidly rising bond yield spreads in sovereign bond yields. The spreads in sovereign bond yields between the affected peripheral member status of the Greece. That means in the Europe, that in the periphery there are some countries uh, the that critical issues were faced by the Greece, Ireland, Portugal, Spain, and most notably Germany. Right. So those were the countries that faced this crisis. It begins in 2009 with the collapse of Ireland's banking system and peaked between 2010 and 12. So it has been started in Ireland in 2009, but you know that all these countries are interlinked, and you know that they all have a very common monetary system, so that crisis happen in one country, it has a very direct spillover effect for the other countries as well. So it peaked between 2010 and 12 and affected many countries. The latest one is the coronavirus pandemic. Now, as I described, that it has become an economic crisis now. Now we consider it as an economic crisis, another crisis in the world, as the world has been put in a great lockdown. So because of that lockdown condition, as I mentioned already, that most of the economic activities stopped. That people could not move from one place to another place, so that they could not doing their day-to-day activities. So most of the financial market start to die out. So died out, that means that no liquidity in the market. So the magnitude and the spread of collapse in activity that has followed in unlike anything experienced in our lifetime. That it is that here first I mentioned that the global financial crisis, it refers to as a great recession, but again here uh, most probably people will consider this pandemic crisis as well as a great recession. We don't know, because it's still that the viral is not 100% under control. The magnitude and speed of collapse in activity that has followed is unlike anything experienced in our lifetime. That this makes the worst recession since the Great Depression, and far worse than the global financial crisis. So these are not my opinion, but some of the very prominent economists that they have mentioned that it can be so. We don't know actually what will happen. We all hope, we are all hoping that the condition will be improved and all the economies will recover soon. Okay, so yeah, we are going to discuss some more about the crisis and instability. Since the financial crisis, world has been experiencing a number of problems such as persistently low inflation and unemployment, right? that this is about that global financial crisis, which started in 2007 2008. Because of that financial crisis, most of the countries that they were experiencing low inflation situation, and also unemployment were there, inequality, because that people are most of the people are unemployed, so that there is no uh, uh, consistent income for all the people, so that there is a growing inequality in many countries, both private as well as public debt. Public debt is an issue not only for Sri Lanka, that we know that today it is one of the critical issue that we have. Yeah, right. Uh, Along with the foreign exchange crisis that we have today, and structurally low aggregate demand, right? Low inflation combined with the low aggregate demand in many Western countries that we can see. At the time that the coronavirus crisis started, that this was the conditions that many of the countries were facing at that time. That they all many of the countries, they have low inflation plus unemployment, and also they had some both private and public debt issues and low aggregate demand. So under that kind of environment, that countries has to face the coronavirus crisis, right? So that this health crisis has accelerated many of these macroeconomic trends, right? Because of that health crisis, those macroeconomic issues they were they will get worse, and reassess the relationship between monetary and fiscal policy. What it means that the many of the economics that they have to think how to face these issues, right? By changing the monetary policy as well as the fiscal policy, what they are all. So the many countries start to reassess the relationship between the monetary and fiscal policy. So that relationship in between the monetary policy and fiscal policy, that we know that we already discussed uh, how the both policies uh, to go together without any controversial. At the same time, we discuss about the independence of the central bank as well, right? So at that time, we discuss the role of the monetary policy and the fiscal policy. They should not contradict with each other. So that now, because of that health crisis, many of the economies that they started to rethink or reevaluate what should be the role of the monetary policy and the fiscal policy, and how they are going to contribute to overcome the issues because of that health crisis, like that. The structural characteristics of a post coronavirus economy, right? Uh, it will include, right? We know that after the financial crisis, right, global financial crisis, many of the countries, they were facing different issues, that we discuss about some of the common issues that were facing by many of the countries around the world. So that structural characteristics of the post-coronavirus economy, that we can identify it like that. Structural microeconomic inefficiencies here with respect to the condition of the Sri Lanka also, that we can see that restaurants and hotel with fewer guests, right? We all know that our tourist sector, which is one of the sector adversely affects by the health crisis, the pandemic situation. Restaurants and hotel with fewer guests, more safely precautions in production chains. So that in case of Sri Lanka, that we know normally we earn our foreign exchange through the garment industries, but we know that how the production is happening there in a factory, right? So that chain of actions are there. So with the safety precautions that they have to proceed with their production. So it is not going to give you the expected productivity or the outcome, right? So at the same time, I hope that you remember how that garment factories uh, uh, started to spread corona viral, right? Remember that because of that, the nature of that production process, that almost all the people that we have, they have to work together. So it is it they were the place where the breeding the virus like. So we know that not only for Sri Lanka, for many of the other worlds that uh, that their production chains also were badly affected due to this viral. Larger reserves and supply for strategic sectors, right? So this is the other structural macroeconomic inefficiencies that we can see and identify, that larger reserves and supply for strategic sectors means that many of the economies that they have given their focus into a strategic sectors, so that they have given priority for that these sectors. Likewise, because of that, uh, that countries are in trouble now, because when there is some strategic sectors are there, when these sectors are not going to give you that contribution, right, to the overall GDP growth, that the the whole economic system is in a trouble. The second one is the large role for the state in the economy. So we saw that in this health crisis also, uh, that the role of the state of the economy, it has a very big role to play. So because this is a health crisis, that the health sector, that there is a very prominent role to play, which is basically in most of the countries, it is under the control of the state sector. So that the state sector has to play a big role. Higher public debt, we all know that uh, in our case also, that we can identify it as a very uh, uh, specific kind of a issue that we have. Lower consumer spending and corporate investment due to high insecurity lending to lower inflation. So uh, at the global level, that we experienced during the past decades, that we could experience a lower inflation, that most of the trade commodities in the international markets were at a very lower rates. Because of that, low inflation was there. So that lower consumer spending and corporate investment due to high insecurity, right? So it leads to low inflation, right? So that people are not tend to spend more and more, and also investments are at a lower level. So that's why that inflation is lower. Governments and the central banks respond to this by fundamentally contemplating their common purpose and reformulating their key objectives. So normally that at the time that we discuss about the central banks, the leading central banks, that we saw that what what are the objectives of the central banks, right? Basically, we saw that almost all the central banks, that they have to maintain the financial at a very low and a stable level, right? So the Fed and ECB, that it is at 2% level, like that. At the same time, that they have to ensure the higher employment and also the stable growth, the sustainable growth. So they have to uh, maintain the economic conditions, or they have to ensure there is a favorable economic conditions to have a sustainable growth in the country. So those were the key objectives of many of the central banks. Some decided that monetary policies should stimulate growth and have more mild inflation targets. So some of the countries that they argue that the monetary policy should focus to stimulate the growth, right? But they have to give uh, focus on the inflation target as well, but first the for the growth, right? While a radical group even advocates negative interest rates, right? So that means that some of the radical groups, that means some countries, that they have to go for negative interest rates as well as a redistribution mechanism and to stimulate spending and investments. When there is a very low interest rate, that we know that it can stimulate spending and investment, because under lower interest rates, that people uh, they are not going to keep their money idle, that they are going to that save. They are not going to save, but they can either borrow at a lower rate and they can invest, as well as that they are going to utilize their savings in activities, right? So that's how that low interest can stimulate spending and investments. Outside of these macroeconomic developments, there are also broader outbound developments determine the future of monetary policy and central banks. So those were actually the macroeconomic developments that almost all the countries are expecting, that they have to maintain a low and a stable inflation, at the same time that they have to ensure the growth as well, right? So for that, they use their interest rate as the main or the key monetary policy tool. But because of that crisis, right, it gives instability, where that many of the that countries, that they have to, that economies, that they have to think outbound, right? That they have to not just focus on these key objectives. They are they have to go beyond that. That what it says, that crisis situation that always uh, persuade central banks to implement some new monetary policy mechanism. We already discussed about unconventional monetary policies, and that we discussed about that quantitative easing, negative interest rates and all rates as well. So now you already have an idea about what I mean, that because of that crisis, that always that crisis situation is not the normal situation. So that the the tools or the mechanism that works in the normal situation is not going to work in that a special crisis situation the same way that they work in the normal situation. That's why that central banks, that they have to think of going beyond, so that the change in the role of the central banks today. The role and conduct of monetary policy has often changed in response to economic and financial crisis. During this crisis, central banks around the world implemented different kind of measures to stabilize the situation, right? Compared with the period before the financial crisis, right? Just over 10 years ago, means that before the global financial crisis, monetary policy has changed radically, and monetary policy toolbox today looks very different. So there are so many new tools are in the toolbox now today. Most of the central banks, that they have implemented new uh, frameworks. Back then, that means that before that uh, before the crisis situation, adjustments of the policy rates were seen as the only monetary policy. Normally, in our case also, that we know that under the conventional monetary policy framework, that we know that at present that we are having a flexible inflation targeting framework, monetary policy framework. under that also, that what are the tools that we are using. We are using open market operations, so we are uh, influencing the level of the liquidity, short-term liquidity in the market, right, short-term markets. By doing so, that we are going to change the interest rates, short-term interest rate, right, as well as that in our case that we have policy interest rates, right. Hope that you all remember that we discussed in detail about the standing deposit facility rate and also standard lending facility rate. So these are the policy rates that we have, and also the bank rate as well. These all are the policy rates that many of the central banks around the world that they use the interest rate, right, or the policy rate as the key monetary policy tool, right? But these days, most central banks work with several modern tools. So today we are going to discuss about some of such modern tools. The recent crisis warranted authorities to pursue extraordinary policy measures, including fiscal stimulus and excessive monetary accommodation. So the recent crisis that they, the authorities here, the authority means either the government or the central bank, so that it perceived those, they persuaded that these authorities to change their policy measures, right? So at the same time that central banks implemented new monetary policy tools, the governments, they also had to adapt new fiscal stimulus packages to boost the economy, because that the very global level of liquidity in the market, to boost the economic activities, that we had to pump money into the system. So the treasury or the government and also the central bank, that they have to implement excessive monetary accommodation. Particularly, central banks adopted unconventional monetary policies, including quantitative easing. So that you already have an idea about the quantitative easing. Monetary policy and the way of doing monetary policy has changed, but the objective of attaining the inflation target still remains. So whatever the monetary new or the modern monetary policy tools are implementing, but still that the ultimate objective of maintaining the inflation, the sustainable price stability is still there. That objective, it is that mandatory objective of the central bank, that it's still that all the central banks around the world, that they have that responsibility on their shoulders. And all the time, central banks need to stand ready to develop new tools and make new kinds of analysis so that they reach inflation targets. So we can see at the time that we are going to discuss the new tools, that how they're going to support the crisis situation with developing new tools, right? At the same time that they are, how they worry about the inflation targets, because that all the central banks at the time that they are facing the crisis situation, that they have some predicted the inflation targets and also output targets. So if the central bank is not going to that, because we know that always the central banks, that they are giving forward guidance to the market or the economic agents. So that's how that economic agents are going to take their that decisions, right? Consumptions or the investment decisions, and they work upon with some predictions in their mind, with the support of that the guidance given by the central banks. So that central bank has that responsibility to preserve that credibility, or otherwise that when the central bank is going to lose the credibility, means that people are not going to take their decisions accordingly, right? So that it is that it is kind of a challenge that central banks have. Past and prevailing experiences remind that the future is always uncertain, and that pre-preparedness for crisis need to be a central element of monetary policy. So this is actually what the learning outcome of all the recent experiences had by the central banks around the world, that consecutively that they had to face three crises. So in the future also, that we cannot expect that it will not happen again. So because of that, that rapid changes in the financial system at the beginning of the session today, that we discuss how rapidly changed the global financial and trade environment. So with that most of the economies are now very open to any kind of a global trends. So that crises are also there is a more probability for the crisis to happen. But there are so many precautionary measures have been taken by the central bank. But still, that with the rapid changes and the new developments, the central bank has to be prepared. 20 years ago, a different view prevailed, and the approach to monetary policy was based on fairly stable macroeconomic environment. So now we cannot expect that fairly stable macroeconomic environment. Always that internationally, that we cannot expect that. Even domestically, that we cannot expect that a stable macroeconomic environment all the time, because of the openness that we have to the global trade as well as the capital markets. But today the world changes, so the central banks need to change with it, right? So it is the message. So monetary policy to tackle the coronavirus crisis. So this is the latest crisis that we are experiencing, that crisis. So that my session, that I focus on the policies that many of the central bank have been taken to face this crisis. The focus of the economies was to ensure that there is a good access to liquidity and keeping interest rate low. So at the time that they had to face crisis, many of the central bank around the world, that they have to ensure that there is a good access to liquidity. So in many countries, that we saw that in the financial markets, that completely dry out those markets, right? That liquidity was very low because of that. Always the crisis brings that uncertainty, so that no one is going to invest, or they are not going to take their financial decisions, right? So that market started to dry up. So that's why that central bank has to ensure that there is enough liquidity in the market. To do that, they have to keep interest rates low. Right? Central banks wanted to provide the economy with the best condition possible to recover after the coronavirus pandemic, and as usual, to get inflation to develop in line with the inflation target. Right? So many countries, that USA as well as in other developed countries, that at the time that they faced the health crisis, that the that interest rate were actually at a very low level, right? And also that the inflation also were at a very uh, control, that under control, where that they have given the target as 2%. That so that because of the crisis situation, after the crisis also, that we can say many of the countries, that there is a tendency for the inflation to drop down. So that most of the countries, that they need to get the inflation to develop in line with the inflation target, where it should be at 2%. A number of different measures have been taken by the authorities to ensure that there is plenty of liquidity in the economy. In general, these measures by the central bank and governments around the world, the pandemic has not turned into a financial crisis. So that I think that many of the countries or the central banks, that they could manage the situation, right? Manage that health crisis situation without growing into a financial crisis by taking necessary policy measures on time. Right? In general, these measures by central banks and government around the world, the pandemic has not turned into the financial crisis. That crisis means actually that overall economic performance are going down. But in our case also that we saw that, right? Uh, we had a very negative rate of growth reported for the year 2020. So then for our country, it was a very unpredictable situation where we had to face the crisis. These measures entail a different way of conducting monetary policy compared to the one that was part of the prevalent approach from the time before the financial crisis. So that many of the central banks that they have to uh, take some different measures or the new measures, but in general that we can say most of the measures that they have taken to face or to provide liquidity into the market are more or less same to the measures that they have taken during the financial crisis, but going beyond that, some central banks that they introduce some more modern tool. Okay, so anyhow, instead of one tool, which is the policy rates, central bank now use several different tools. In our case, in Sri Lanka also, that uh, the central bank of Sri Lanka, they implemented different policy measures at that time. Previously, the focus lay on influencing the financial conditions via short-term risk-free interest rate that uh, primarily affect the bank's funding. At the time we discussed about the monetary policy, that we saw uh, through changing the policy interest rates, what the central bank is doing, that we are going to influence the short-term interest rate in the short-term markets, right? And also that central banks conduct open market operations uh, based on these transactions are based on the collateral. What are the collateral? Basically the government securities. So risk-free operations are there. Risk-free interest rates that primarily affect the bank's funding. So that these interest rates are basically effect on the bank's lending or the fundings, that the banks, only the commercial banks or the primary dealers are dealing with the central bank. So whatever the policy rates implemented by the central banks are going to affect for the funds requirement of the banks. So afterward, it is going to be transmitted to the long-term financial markets or the long-term securities. Likewise, that monetary mechanism is working. That's how we analyze that conventional monetary policy is working through the monetary policy transmission, right? But now, central bank introduced measures that directly affect more long-term and even non-risk free interest rates, right? At the time that we discuss about the unconventional monetary policies, specifically the quantitative easing, that we saw how the central banks inject money, right, by buying long-term securities from the market, not only directly from the commercial banks. Going beyond that, central banks are going to accept some long-term securities as well. So these two can lead to the intended effects on the interest rates and other credit conditions that households and companies face, and thereby to the desired effects on capacity uh, utilization and the rate of inflation. Because why that under the unconventional monetary policy, that central bank has to go and touch that long-term interest rate, because otherwise it is not going to give the rapid result. That means that it is that when the central bank is going to influence the short-term interest, that it takes time to uh, impact on the real sector. But when the central bank is going to touch up the long-term markets or the long-term securities and all, that it can influence the long-term securities, where most of the that the long-term yield rates can be changed accordingly. So that's how the central bank has to take some unconventional policy measures, right? So now, as I already mentioned, we are going to discuss about the European Central Bank's monetary policy measures against the coronavirus crisis, right? So in this session that I'm going to focus on uh, European Central Bank monetary policies as well as the Fed uh, USA Central Bank, that Fed's monetary policy measures. But other than that, I recommend you to read uh, the monetary policy measures introduced by the Central Bank of Sri Lanka. There is a press release. So I will ask IBSL administration to share that particular press release with you. I will share with them so that it is going to be available for you as well. So other than that, you remember that what are the other leading central banks that we focus on at the time we discuss about the leading central banks around the world. So you have to read about the monetary policy measures taken by other leading central bank as well. So right here today, the discussion is focused on basically the ECB's monetary policy measures and also Fed's monetary policy measures. Now we are going to let's start with the ECB monetary policy measures. The three main tasks for the ECB since the onset of the pandemic have been, right? So at the time that they have to face the pandemic situation, that there were some three main tasks have been given to the ECB to stabilize markets, to protect credit supply, and to neutralize the pandemic related downside risks to the inflation path, right? Normally we know that the first task is about the stabilized market, where as I discussed, that because of the crisis, it always gives the instability. So that it is there to protect credit supply means that there is no enough credit, that there can be a credit crunch. And to neutralize the pandemic related downside risk to the inflation path means that people are not going to do the economic activities, that people are not going to consume as the same way that they were consuming. So there is a downside risks to the inflation path. We all learned about what is their midterm inflation target is, to maintain it at a 2% level, right? So but with the crisis, that they saw that there is a tendency for the inflation to go down, so that they have to take it back to the expected path. That it is another task. In addition to the prevailed low level of policy rates and previously installed forward guidance on the future path of interest rates. So, under the conventional monetary policies, at the time that they face the crisis, that they have already implemented, that the policy rates that they have implemented is already prevailed at a very lower level, and also that they have already given uh, forward guidance, right, on the future path of interest rates, so that they have announced that. So that ECB introduced a comprehensive package of complementary measures that acts along two main dimensions, because that already at the time that they face the crisis, there is a very low level policy rates are there, right? So that's why that they have to introduce this new two measures: asset purchase and the liquidity operations, right? For asset purchase, that these are the two key monetary policy measures that they have taken to face the crisis issues. For asset purchase and extra 120 billion pounds was added to the ongoing asset purchase program, right? That ongoing asset purchase program, that I think that we have already discussed about this asset purchase program at the time that we discussed about their monetary policies, right? So that they have to add some more funds into that, right? And also that there is another asset purchase program. It is called Pandemic Emergency Purchase Program. So better you remember that new purchase program, because it is specifically designed to face this health crisis or the pandemic, right? So that they introduced it as well. For liquidity operations, the main element was the revision of the structure and pricing of the targeted longer term refinancing operations, right? That they have done some revisions of the structure and pricing of the targeted longer term refinancing operation. That mechanism was also implemented by them before the crisis, but they have introduced some new structural and pricing change to that targeted long-term refinancing operations. These flagship initiatives were accompanied by a suite of supporting measures, including the easing of collateral framework along various dimensions. So that this was their flagship initiative. They are targeted longer term refinancing operations. That normally we know that under the open market operations, that central bank provide liquidity for the commercial banks for a very short term basis, right? In our case, that is overnight basis. For sometimes that we saw for 7 days, right? For the period of 7 days, for very short term periods. But here it is not like that, right? Because this can be considered as unconventional monetary policy tool, where that they are targeting for a long term refinancing operation. Refinancing operations means that the central bank is providing funds through the banking system, where that banks first they have to use their funds to lend, use their funds in the first place. That central bank is going to refinance these operations like that. So anyhow, that this actually considered as the flagship initiative, that is the very specific or the very important or the key initiative that they have taken, right? So, and also that for these lendings, right, longer term refinance operations, for the lending purposes, that the central bank, European central banks, that they accommodate very easing of the collateral framework. That means that collateral base, that they made it very easy. So normally we know that for the open market operations, that the central bank is accepting very risk-free securities like governments, bonds, and securities. But here, that collateral framework, that they make it more easy, because anyhow they need to minimize the risk. That's why they need to have collateral. But when there is a very low level of risk-free securities, that anyhow that central bank has to lend, so that they can ease the collateral framework, right, and various dimension. That means that they can accept some private collateral as well, cooperative bonds as well. And also the time that they have given, this is specifically said that it is a long-term refinancing operation, so that we can see sometimes that they can lend money for 5 years, or even that they can give some concessions, or that repayment fee free period for 2 years, like that. The EP, that it is the Pandemic Emergency Purchase Program, that the pending emergency purchase program and the easing of conditions under the long-term refinancing operation program have been the two cornerstone of ECB monetary policy response. So that you have to remember that under these two policy mechanism, that they have make a condition, that very easy condition, so that they have make the conditions very is for, because that easing conditions to make sure that liquidity is, or else with all the tough conditions that they had under the conventional monetary policy, that there is no way that they can increase the liquidity level in the market. So that's why under this policy instrument, that they have eased the conditions, so that because of that they are considered as the key monetary policy responses against the health crisis. Their design and calibration are directly linked to the evaluation of the pandemic and its impact on the monetary transition mechanism. So these are directly pumped to the system, right? So through these programs, that they can inject liquidity directly to the real sector. So it is going to be more effective, right? So that it make easy, right? So it gives impact on the monetary policy transmission mechanism. So it is going to work very effective manner, right? So that's why these are very impactful to face the pandemic situations. And this is PEPP. The PEPP is for Pandemic Emergency Purchase Program. It plays a dual role of stabilizing financial markets and contributing to easing the overall monetary policy stance. Right, the stabilization function, which is facilitated by the ability to purchase volumes in a flexible manner over time across asset classes. So that it means that that they can purchase, right? Purchase assets means that the collateral that they are taking, right? So that they can purchase assets, right? So across asset classes means that there is a wide range of assets, right? So that because that there is a possibility for them to accept different kind of assets, means that there is a probability to increase the volumes, purchase volumes, that there is a flexibility. Sovereign bond yields in turn are central for determining the funding conditions of banks, corporates and household across the euro area. So now you can see that sovereign bond yields, right? So that it is the government bonds, that interest rates, the government bonds in turn are central for determining the funding condition for bank. So we know that bond yield rates are there is a link between the funding conditions of bank, corporates and household across the euro area. That means that when it determines that bank's rates, that bank is going to lend based on those rates. So it is going to be impact on the corporate sector and also the household sector, right? Moreover, that pandemic, what is that? Pandemic Emergency Purchasing Program is the monetary policy stand by extracting duration risk held by investors. Right here, that there are so many flexible conditions have been given by pushing down the medium to long end of the yield curve. Right. So this program also reinforced the impact of negative interest rate and forward guidance on the path of policy rates, that we discussed about that at the time that they had to face coronavirus, that they were already implemented very low interest rates as the policy rates. So now that they could reinforce the impact of negative interest rate and forward guidance on the path of the policy rates. The easing of the condition going the TLTRO, that it is that the other measure that they have introduced, targeted longer term refinancing operations. So that they have basically introduced that measure already, but they have eased the conditions more and more, right? It has been crucial in warding off the risk of credit crunch, so that they could control that the possibility for the credit crunch, because that they could uh, facilitate more and more with the liquidity to the market. These effects were reinforced by an easing of collateral requirement. We already discussed that they made easy the collateral requirement to ensure the banks could make full use of the operations. Or otherwise, at the time that bank, when they are running out of collateral, that they cannot use that facility. That's why that they allow some other type of collaterals as well. So this facility incentivizes banks to lend the real economy. So that, as I said, that it is a refinancing operation. So that scheme, so that the banks that the initial state that they are going to lend to the real economy, right? So that that banks know that they can compensate that the funds that they are lending to the customers using the uh, by going back to the central bank with the very easy mode of collateral, so that they motivated to lend the private sector. These operations have substantially supported the granting of loan to the non-financial private sector, have been effective in easing terms and conditions on bank lending, and have helped keep lending rates near historic lows. So that actually because of that program, that is why at the exam also, that sometimes you may ask that what are the measures have been introduced by the leading central banks against the pandemic crisis, and how those measures have been worked to recover. So that at that point, that you have to justify that how they were successful, because under this policy measure, that because of that easing conditions, that the banks could lend for the private sector under very the easing condition terms and conditions, so that we know that many people that they can obtain loan from the bank. Normally, that we know in the normal scenario, that it is very difficult for the people to obtain a loan. There are so many hard and fast rules there, right? Because no any financial institutions need to uh, have the default payments, right? So that's why. But here, that central bank has eased the conditions, because that the central banks need to ensure that that liquidity is in the market. So they anyhow that they have to encourage banks to lend for the public, right? So, and also it have helped keep lending rates near historic low, at a very lower rate, that they uh, give loans to the customers. In relation to business investment, supportive policies such as loan guarantees and uh, moratoriums, right, together with capital relief provided by supervisory authorities. For the business investments, that they have given some more uh, uh, the supports, right, funding supports, that loan guarantees, that they make free of loan guarantees, and they introduce moratoriums, that they are that for the loans that they have obtained, that there is a free time that they no need to pay their interest or the capital, uh, the capital for a particular period, right? Capital relief provided by the supervisory have also been effective in uh, averting a liquidity crisis. So it also prevent the economy is going for a liquidity crisis. This has also allowed firms to finance working capital and compensate for diminished revenues. So that because of the pandemic situation, many of the business firms that they cannot perform well, basically they cannot earn the revenues as usual, and also they cannot find funds for the working capital. So that these instruments that the central bank introduced that solve those problems, which has been fundamental for heading off a wave of insolvencies and permanent damage to productive capacity, as well as protecting jobs. So because of these facilities, what they could achieve is that many of the business firms, that they no need to go for a shutdown, and without having a permanent damage to their productive capacity, means that there is kind of a interruption in the middle because of that, the pandemic situation, and that social isolation as well. But it is not going to give them a permanent damage in their capacity, because they could regain their businesses as well as protecting jobs. So they normally in Sri Lanka also, that at the time Central Bank of Sri Lanka introduced that a special refinancing loan scheme, focusing the business entities who highly affected due to pandemic situation, that very many relief measures have been introduced with that packages, in the same way that the central bank also uh, encourage bank to easing the collateral requirements, right? And those that refinancing schemes that the central bank introduced, uh, that basically focus to cover their working capital requirements. And at the time that central bank providing these loans for these business entities, they always consider uh, the possibility of protecting their productive capacity, means that they are going to survive, and also that people work in these business entities are not going to lose their jobs. These are the concerns, or the things that central bank consider when they are providing loans for the business entities to uh, restart their businesses under the pandemic situation, right? So normally at that time, that market interest rate was really high, but Central Bank of Sri Lanka introduced that special uh, program to lend the businesses entities through the banking system at 4%. It is a considerable, very low level of interest rate, right? So that, as I mentioned, that I encourage you to go and read the press release that central bank has published, including all the policy measures that the Central Bank of Sri Lanka has been introduced against the coronavirus, the pandemic situation. So I'm going to circulate among you as well, but at the same time, I encourage you to read that, okay? So you can understand that the similar kind of measures have been taken by the Central Bank of Sri Lanka as well. And always that the central bank needs to reboot the economic activities with those unconventional measures, right? So otherwise uh, that actually that by the fiscal policies only it cannot do, but because that we can see that there are several policy measures have been taken, that fiscal policy measures has also been taken by almost all the countries, right, to address this health crisis. But at that same time, that the role of the central bank, that it was very specific role that they have to play, and it is more impact and effectful, right? So that's why it is uh, very important to learn this, right? So that now we are moving towards to the Fed's monetary policy measures, right? So let's see what are the measures that they have introduced in 2020 against the pandemic situation. The Federal Reserve steps in with a broad array of actions to limit the economic damage from the pandemic, including up to 2.3 trillion of US dollars in lending to support households, employers, financial markets, and state and local governments. Right? Inside this package, that we can see there are very different type of unconventional measures that they have taken. We know that federal fund rate is actually a conventional monetary policy tool that they have, right? So the Fed has cut its target for the federal fund rate, the rate banks pay to borrow from each other overnight. So we already discussed about federal fund rate at the time that we discussed about that their monetary policy framework. So you already know what is federal fund rate. So they have actually they have cut its target for the federal fund rates, right, by a total of 1%, 5 percentage points since March, uh, 3rd March 2020, bringing it down to a range of 0% to 0.25, 0.25%. Right? The federal funds rate is a benchmark for other short-term rates and also affect long-term rates. So this move is aimed at lowering the cost of borrowing on mortgages, auto loans, home equity loans, and other loans. But it will also reduce the interest income paid to savers. So nothing much new here, but the same thing that we discussed at the time we discussed about the monetary policy. So here that federal funds rate is the key monetary policy tool that they are using. So at the time of the crisis that they have further cut down that rate, right? So, and this rate is actually kind of a benchmark or giving the strong signal, or that it works as the benchmark for the short-term rates. So, as I already mentioned today as well, I mentioned that policy rates are directly linked with the short-term financial market rates, where it is going to just change or impact on the short-term rates. So the Fed rates also like that, federal fund rate, that it works as a benchmark for the other short-term rates, right? And also affects the longer term rates. But after that, okay, it takes little more time to transmit it to the longer term rates. So this move is aimed at lowering the cost of borrowing. So that ultimately, what is the objective of the Fed is to lower the lower the rate in the market. So market for what? The borrowing on mortgages. That means that the bank rates, that commercial banks rates that they are offering for the customers to borrow on mortgages, auto loans, home equity loans, and other loans. So that these all type of instruments are actually reflected the activities of the real sector. That means that when the interest rate is going to be lower, lower and lower, that people will borrow more and more. They will borrow for on mortgages, means that they are going to invest in real sector, right? Or even that they are going to purchase car or a house or like that, that it is going to impact on the aggregate demand. So likewise, that it it helps maintain the inflation at the expected level of 2%. That I said you already, that inflation, that there is a tendency for the downward tendency there, because at the time of the crisis that it is a very unpredictable, right, situation where all the people are not going to take their decisions, financial decisions, so that all the financial activities are not going to activate at that time, that all are deactivated. So that's why there is a pressure for inflation to come down. But when there is a deflation, it is more difficult to boost the economy again, to get it up, right, to get the rebounds. So that's why that Fed needs to motivate the economic agents to take the economic decisions, to spend or invest more and more, right? To keep the uh, economic momentum. That means that people are going to purchase, means that there is a upward trend, the aggregate demand is increasing. So the economic, especially the investors, that they will like to invest because that they can see that the market is moving. So that's how that they are going to be motivated to do their production, right? So that's how that overall economic performance is going to be activated. Okay, so that is the first policy measure. It is actually a conventional measure. But using the conventional policy measures also, that Fed uh, try to arrest that crisis situation. Forward guidance, the using a tool honed during the Great Recession of 2007-2009, the Fed has offered forward guidance on the future path of its key interest rate, saying that rates will remain low until labor market conditions have reached level consistent with the committee's assessment of minimum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. So that is their key statement, that what they have uh, declared to the public. So it gives the forward guidance to the public. I already mentioned today that the central bank policy measures are actually considered as forward guidance for the key economic agents to take their decisions. So based on that as that statement, that they know that Fed is going to maintain that inflation is at that level, and also that very low interest rate, and also that actually at the time that we discussed about the objective of the Fed, that you may have remember, I think that they have given more priority for the unemployment, that unemployment, to reduce the unemployment rate as well. Likewise, that for some countries that we saw that that inflation plus the output, and some countries that inflation plus the employment rate, like that. So here that this is what they have uh, announced to the public, right? Right, so that is actually the forward guidance that they have given to the public at the time that they had to face the crisis. This forward guidance on the overnight rate, updated in September 2020 to reflect the Fed's new monetary policy framework, puts downward pressure on longer term rates. Okay, so now this is actually the midterm, that therefore forward guidance, it's always like midterm policy measures, that always that forward guidance have been given, right, predicting the midterm level. But that accordingly, that the economic agents, that they take their expectations, that they build their expectations. So based on their expectations, actually the market works, right? That's how that the real that condition is making, right? uh, that real situation actually driven by the expectations of the uh, that economic agents, right? So that going beyond that forward guidance that they have already given at the time that they have faced the crisis, but that they have updated that their forward guidance in September 2020 to reflect the Fed's new monetary policy framework. So that the they are and they implemented a new policy framework to face the crisis. So that accordingly that they have updated their forward guidance, put downward pressure on longer term rates. That here with the federal fund rates that we saw, that they are going to directly influence the short term rates, that it takes some times to influence the long term rates. But here that they puts downward pressure on the longer term trades, right? So that's how they have made up their new monetary policy framework. Okay, so let's see what are those new monetary policy measures. That there is a list of measures that I could see in their website, but here I have taken only few of the measures that they have introduced, right? So better you can remember the name of different measures, policy measures, and also the impact, right? And also the objective of measures and the impact of these measures. That's what normally you will be that asked in the exam. So supporting financial market functioning, securities purchase, right? It is actually a measure of quantitative easing that we have already discussed, right? It is actually not the very modern thing, but they have used this policy measure at the global financial crisis as well. The Fed resumed purchasing massive amounts of securities. They resumes means that they have already used that measure, right? A key tool employed during the Great Recession, as I told you, that they have used this tool during the Great Recession in 2008-9 as well. When the Fed brought trillions of dollars in long-term securities, Treasury and mortgage-backed securities markets become dry functional after the outbreak of coronavirus, right? So that as I said that many of the financial markets that it started to dry out, right? Because that no one is going to invest, or they are not taking their decisions. So that's why that most of the leading financial markets also that we saw that they started to deactivate it, like, and the Fed's action aimed to restore smooth market functioning so that credit could continue to flow. So that's why that the credit should be there, the liquidity should be there, right? In March, that Fed said that it would buy at least $500 billion in treasury securities, right? And what the central banks wanted, that their mechanism is to buy treasury securities worth of $500 billion. That means a big money that they are going to buy that money from that there is no other players in the economy. That means that there is no investors, that because of that uncertainty that they are not going to invest in anything. So the central bank has to activate the market by buying securities. So by doing so, that central bank could uh, inject liquidity into the market, right? So and 200 billion in government guaranteed mortgage backed securities over the coming months, that they started with the treasury securities, and then they declared people that they are going to buy government guaranteed mortgage backed securities as well, right? Then on again at the end of March, it made the purchases open ended, right? Saying it would buy securities that always. Now here you can say that first that the Fed is announcing what is going to be their policy measures. So people, it is also like a guidance that the central bank is giving, so that to re-stabilize that confidence on the investors or the economic agents, right? So that's how that we have to rebuild the confidence level of the public to get them back into the that operations, the financial operations in the market. That's saying it would buy securities in the amounts needed to support a smooth market functioning and effective transmission of monetary policy to broader financial conditions. Market function subsequently improved. So because of that, these measures, that market functions gradually started, right, to work again, and the Fed narrow its purchases through April and May. So then that they started to narrow their purchase through that in when it comes to April, May, that that the Fed observed that the market is started to function. So on June, however, the Fed said it would stop uh, tapering and would buy at least 80 billion a month in treasuries and 40 billion in residential and commercial mortgage-backed securities until further notice, that they are going to stop taking these type of securities, because that they could see that there is a kind of improvement. Between mid-March and early December 2020, the Fed's portfolio of securities held outside grew from 3.9 trillion to 6.6 trillion. So that you can see that how much of assets that they have purchased. So that is the value of the purchases, that security purchases that they have done during these periods to provide liquidity into the market, lend into securities firm, right? So that through the primary dealer credit facility, that this is another kind of the policy measure that they have taken. You better remember, it is worth to remember what that the primary dealer credit facility, PDCF, a program revived from the global financial crisis, right? This measure also that they have been used at the global financial crisis, right? The Fed offered low interest rate, so it is currently at 0.25% level, right? So the loans up to 90 days to 24 large financial institutions known as primary dealers. That the primary dealers are the financial institutions that basically act in the primary security markets, right? So that in case of Sri Lanka also, that primary dealers are there who are participating in the primary bond market at the time that central bank conduct the auctions of the government security bills, that they are the dealers. Actually they are going to buy these securities, so that it is actually the primary market. So that they are the financial, actually there are several large financial institutions, the primary dealers are there in USA, so that this facility has been given to them. The dealers provided the Fed with equities and investment grade debt securities, including commercial paper and uh, municipal bonds as collateral. So that now you can see that what are the type of securities used in these transactions. Basically, under the conventional monetary policies, that we can say the always central bank prefer to use very risk-free collaterals, but when this new modern measures that they have eased those conditions the to promote these programs, or otherwise that the institution that they don't have that much of that government securities, so that they have expanded that collateral base. So you can see that different type of collaterals that they can use under different policy measures. The goal was to keep the credit markets functioning at a time of a stress when institutions and individuals were inclined to avoid risky assets and hoard cash, and dealers could have encountered barriers to financing the rising inventories of securities they accumulated as the made markets. That by doing these activities, what the central bank is expected is to activate the financial markets to ensure that credit market is functioning smoothly at the time, that need to ensure that people are activate and uh, they are they are having more confidence, so that they are not going to just keep their cash idle, but to utilize them to invest or consume. So that's how they wanted to take this cash into the system. And the next thing is supporting financial market functioning. The same thing again, that you can see that these two measures that the Fed have taken to supporting the financial market functioning. Here that the first one, backer stopping money market mutual fund. It is another type of policy measure. The Fed also relaunched the crisis era monetary market mutual fund liquidity facility, MMLF. So I'm telling you again that you better remember these facilities or the policy measures and what are their specific characteristics, what was the objective of implementing those, and what was the ultimate impact of these measures to uh, reboost the economy. The Fed also relaunched this. Relaunch means that they have already used this at the time of global financial crisis, which led to banks against collaterals they purchase from primary money market funds. So now this facility has been given to the banks, right, lend to banks, so that they lend to banks that the ones that invest in a corporate short-term commercial papers. See the collateral that here, that short-term commercial papers, as well as in treasury securities. At the outbreak of the COVID-19, investors withdraw from money market funds, right? So that investors that they withdraw from money market funds, that they are not going to win the market. To meet outflows, these funds sold securities, right? But disruptions in the financial markets made it difficult to sell, even if the securities were all of high quality and very short maturities. The Fed said that the facility will assist money market funds in meeting demands for redemptions by household and other investors. So, see what is the impact that Fed said that this facility will assist money market funds in meeting demand for redemptions by households and other investors, enhancing overall market functioning and credit provision to the broader economy. Right. So that again, the objective is to provide that increase the credit provisions to the broader economy. Right. So to implement these measures, that the Fed invokes Section 13, right? That means that there is a mandate, no, that the framework has been given for the Fed to implement their policy measures. But going beyond, uh, invoke Section 13, but obtaining a special permission from the Treasury, right, which provided 10 billion from exchange stabilization fund to cover potential losses. Sorry for the interruption. So, yeah. So now you can see for these unconventional measures that the Fed has to take with the special permission of the Treasury. And through this facility, they could provide $10 billion from its exchange stabilization fund. It is a separate fund they are holding to cover potential losses, so that they provide credit provisions to the broader economy. That means that they could provide more credit, uh, aiming the investors as well as the householders. Repo operations, right? So the Fed vastly expanded the scope of its repurchase agreement operations to funnel cash to money markets, and is now essentially offering an unlimited amount of money, right? So we have heard about the repo market under the conventional monetary policies, but now uh, to face that the health crisis, that they have expanded the scope of this facility. The repo market is where firms borrow and lend cash and securities short term, usually overnight, right? Disruptions in the repo market affect the federal fund rate, right? So that means that when that repo market is not going to work, right, in a proper way or the usual way, that it is a short-term security market again, where that that Fed's policy rates are going to work through these short-term markets, right? So it is going to be uh, impact into the real sector through this market, as I explained. But when that short-term market is not going to function well, that it has a concern. Why? That that disruption in the repo market affect the federal fund rates, right? It is the Fed's primary tool for achieving its price stability and employment mandate that they have given in that is what their mandate is, to stabilize the price, and also the to keep that unemployment under the control level, right? So when that market is not functioning well, means that there is a problem for the Fed, because that their primary policy tool of that funds rate is not going to work. It is not going to transfer to the long-term market and also the real sector, right? So the Fed's facility makes cash available to the primary dealers in exchange for treasury and other government-backed securities. So that the Fed try to keep this repo operations reactivated by facilitating the primary dealers. Before coronavirus turmoil hit the market, the Fed was offering $100 billion in overnight repo and $20 billion in 2 weeks repo. So there are two type of repo operations are there. So that already after the global financial crisis, that the Fed started to offering some funds to keep activate this repo operation, but because of that pandemic crisis, that Fed started to expanded this program, and you can see how much more funds that they have given to activate this market, right? So it is that. And there are some more to talk about the Fed's monetary policy measures and encouraging banks to lend. So now that first we saw what are the measures that the Fed has taken to see here it has mentioned that supporting financial market functioning, right? Again, it is the supporting that we discuss about four mechanisms that the Fed has been taken under their new monetary measures to support financial market functioning. Now, let's see how they have introduced new policy measures to encourage banking sector to lend to their customer base, right? Direct lending to banks. The Fed lowered the rate that it charges bank for loans from its discount window by 2 percentage points, from 2.25 to 0.25, lower than during the Great Recession. So let's see that it is kind of a facility that the Fed has given for the banks, that the bank can that borrow money, right? It is called the discount window, that there is a rate, right? The overall meaning is that the funds are available, that Fed is make funds available for the banks at a particular rate. At the time that they cut down the rate, means that funds are available for the banks at a lower cost, right? So that rate has been cut down more than at the time of the Great Recession. So now you can understand what is that the expected impact of the health crisis, right? These loans are typically overnight, meaning that they are taken out at the end of the day and repeat the following morning. So that always that these funds are giving for the banks overnight basis, means that they have to use this fund to operate during the day, and they have to uh, repay the it is kind of a loan, so that they have to repay at the next early morning. But the Fed has extended the terms of 90 days, right? But now that direct lending facility that the Fed has given, that first originally it was overnight basis, but it has extended the term to 90 days. That means for 3 months that they can have this lending, right? For the 90 days means that repayment period is comparatively very long. Banks pledge a wide variety of collateral, securities, loan, etc. So, to obtain this loan, that they can pledge either securities as the collateral, or either the loans that they are good quality loans, even that they can use as collateral to obtain this loan to the Fed in exchange for cash. So that always that this cash counter is there for the banks. So the Fed is not taking on much risk in making those loans. So that the time given is expanded, but there is a collateral behind, right? So that's how that Fed minimize the risk of giving that cash to the banks. The cash allows bank to keep functioning so that they have enough cash. Either people are not going to move, right, because of the instability in the market because of the that pandemic situation. But the banks, they have then now cash, they have cash. Depositors can continue to withdraw money, so that depositors that they can now withdraw from the banks because that now banks have money. So bank also can give new loans. Banks are sometimes reluctant to borrow from the discount window because they fear that if word leaks out, that means that when the bank is coming to the central banks to borrow money, that it is not a good thing for their good name, right? So that banks are reluctant to come to have cash through the discount window. So to address this issue, right? So 8 big banks in the Fed system agree to borrow from the discount window, so that some other banks also that they have a kind of an agreement to borrow from this window, that making it more usual thing. Or otherwise, that people think that that one particular bank had cash through the discount window means that the bank is going to be collapsed. So that bank is going to lose its reputation, and also that confidence that the people have on them. So that's how they stop that. Temporarily, the other one, that how the encouraging bank to lend, temporarily relaxing regulatory requirements, right? We know that normally under that we have discussed about the Basel III and all, what are the regulatory requirements that the central banks are having over the functions of the commercial banks. But at the pandemic situation, the Fed is encouraging banks, both the largest banks and community banks, to dip into their regulatory capital and liquidity buffers, right? So that normally that there is a capital adequacy that basically according to the regulatory requirements, that always that particular financial institutions, that they have to keep separate their capital, or that they have to keep some liquidity idle as a buffer stock, right? So but in the pandemic, under the pandemic situation, that central bank uh, uh, allowed to reduce these buffers and use this liquidity to lend. Okay, so they can use this liquidity and the capital, that they can use the capital requirement as well to lend the public. The reforms instituted after the financial crisis require banks to hold additional loss absorbing capital to prevent further bailouts. So that and also there is a reformed instituted, that means that new reform has been introduced right after the financial crisis. That means after the banks, that we overcome this pandemic issue, that bank has to hold additional loss absorbing capital. That means that they have to keep more capital, right? Or the liquidity buffers to prevent future bailouts, means that they are not going to bankruptcy. But these capital buffers can be used during a downturn to stimulate lending and the Fed is encouraging that now, including through technical change to its total loss absorbing capacity. These are all very uh, a specific type of rules that they have formulated with respect to the capital requirements, where now they can, that Fed Reserve, that they need to ensure that the banks are not keep their capital idle but to use at this crisis time, but at the after the crisis, that again they have to ensure that uh, that what that that surveillance is there. That means that they are again going to keep those capital requirements, right? Okay, like that. The Fed also eliminated banks' reserve requirements. The percent of deposits, that we know that in case of Central Bank of Sri Lanka also, that we discuss about the SSR, the statutory reserve requirement, where the percentage of the overall deposits that bank has must to keep with the central bank as the reserves, right? But the Fed also eliminated that bank's reserve requirement as well, right? That in Sri Lanka also, that we also decrease the reserve requirement. It is a percentage, so that to face this pandemic situation, that central bank uh, uh, reduce that requirement as well, right? Through it is largely irrelevant because bank currently hold far more than the required reserves, but it is not going to be that much of effective thing as here it mentioned, because why, that already the banking system, that they have enough liquidity, right? So that this reduction of the reserve requirement is not going to give that much of a additional impact to the system. That what it says. Okay, so the next one is the Fed's monetary policy measures in 2020. Now, here we saw how they are encouraging banks to lend. That here there are three measures that I have mentioned to supporting corporation and businesses. Direct lending to major corporate employees in a significant step beyond its crisis era program. Okay, so that crisis era programs means that at the time of the Great Recession, so the global financial crisis. Now here they have taken some further steps which focus mainly on financial market functioning. The Fed on March, it's again they have taken this step in the March, established two new facilities to support highly uh, rated US corporation. That means that the very big type of corporations, that large scale corporations, the primary market corporate credit facility, right? The primary market corporate credit facility, right? So here that Fed to lend directly to corporations by using bond issuance. And also the second one is the secondary market corporate credit facility. Under this facility, the Fed could purchase existing corporate bond as well as exchange traded funds investing in investment grade corporate bonds. So now you can see basically these facilities are different, right? Different based on the financial instrument that they use to uh, provide these facilities, right? So that is the major difference in between these two facilities, right? These facilities would allow companies access to credit so that they are better able to maintain business operations and capacity during the period of dislocations related to pandemic. That here now you can see that first the Fed encourage banks to lend the business entities. Going beyond that, they are directly supporting the corporation and businesses. That this is a very unconventional step, because normally we know that central banks, that we are not lending directly to the public or the other corporations. Normally that we use the banks as the distribution channel, but here that you can see to accelerate that process, right, to recover the economy soon as possible, that that we cannot wait and see. But that's why that Fed has taken some uh, extraordinary measures actually to reach the fund needs of the corporation and businesses by directly uh, providing funds. But to minimize the risk, that you can see what are the background financial instruments that they have used in these transactions. Initially supporting $100 billion in new financing, the Fed announced on April that the facilities would backstop up to 750 billion of corporate debt. See, now you can see that the magnitude of the support given by the Federal Reserve System. The commercial paper funding facility is another instrument that they use. Here, the commercial paper is a 1.2 trillion market in which firms issue unsecured short-term debt to certain money market funds and others. So at that time, that the value of the commercial papers in that market to finance day-to-day operation. Through the commercial paper funding facility, another reinstated crisis era program, the Fed bought commercial paper, essentially lending directly to corporations for up to 3 months at a rate between 1 to 2% points higher than overnight lending rates, right? So it is higher than the that we saw that overnight lending rates means that federal that policy rate, right? But it is higher than that policy rate. But still, we can say that Fed is supporting the corporations that directly involved in that market to purchase commercial papers, right? Okay. The next one is supporting loans to non-profit institutions. That there are some institutions that they are not performing very well, so that they have non-profits. In July, the Fed expanded the Main Street Lending Program. It is called the Main Street Lending Program. It is again very unconventional policy measures that they have taken. This program aims to non-profits, including hospitals that they are not making profits in their businesses, hospitals, schools, and social services organizations that were in sound financial condition before the pandemic. So we normally know that that in our case also that some hospitals, the private hospitals, that are schools and some other services, that there is a way that with the day-to-day that under the usual operations that they can make money, but because of the pandemic that they cannot perform well, so that during that period that they make non-profits, right? So to regain their operations, right, to ensure that the jobs provided by these institutions are not going to lose by the employees. That's why Fed intervened in these measures. Borrowers needed at least 10 employees. See here that in order to have this facility, there are several eligibility criteria. So the conditions are there, but basically at least 10 employees and endowment of no more than 3 billion. That their resource endowment should not no more than 3 billion. Then they can have that facility. Among other eligibility conditions, that they have to fulfill those requirements. If any institution that they have more than 10 employees, and also their overall endowment is not less than $3 billion, that they are eligible. These loans were for 5 years, but payment of principal was deferred for the first 2 years. That means that they have to just pay the interest only, not the capital, for 2 years. That means a long period. So that's how that the Fed has given concessionary loan for this private sector or the corporations and business entities in the country. As with loans to business, lenders retain 5% of the loans. So these are the measures that unconventional monetary policy measures have been taken by the Fed. Likewise, many of other leading banks as well, that they have introduced some extraordinary monetary policy measures to overcome the issues due to the pandemic crisis. So now I invited you to follow what are the leading central banks that we discuss in these sessions, and also in addition to the European Union Central Bank and also the US Central Bank, what are the other central banks have been taken or done. Okay, the challenging role of the central banks. Since global inflation has already been below target for the prolonged period that we discussed already, that normally we can observe that global inflation is at a very lower level for a particular period. It would contribute to a downward drift in inflation expectation. So that always, as I already explained you, that always that future uh, future inflation is uh, created by the inflation expectations, today's inflation expectation. In this context, it is essential that inflation expectations are anchored by the commitment of the central bank to offset the negative pandemic shock to inflation path and ensure convergence to the inflation aim over the midterm. So as I said you that normally the central banks that they set their monetary policy uh, to achieve their objectives, basically stabilize the inflation over the midterm. But with the pandemic situation that we saw, that many extraordinary measures have been taken. But anyhow, that we can just get out of that basic objective. So at the meantime, that central bank has to show the commitment of the central bank for that, because we have already given the public the forward guidance that they believe that central banks will maintain the inflation at this particular level. But in case that they have the expectation that the inflation is going to go more and more down, that our expectation, based on our current expectation, that future inflation is also going to be very lower and low. So it is not good actually. Deflation situation is not good again, because again that in short term that we can achieve the growth, but in the long run again the countries will fail. Okay, and the other thing is, with these all measures that the central banks has been taken to arrest the pandemic conditions, so the conditions, but it will give a short, actually the very normally we know that like the like many of the fiscal policies that normally we target for a short term growth momentum, right? But the central bank, that they have to ensure more than that because normally the central bank uh, try to uh, operate their policy instruments targeting the medium term, right? So with the measures have been taken uh, to face the crisis situation, it gives growth. It helps increase the growth. But if the growth is not going to be sustainable or at the potential level, again there can be an inflationary pressure. So it is another problem that the countries can face. So always that central bank has to it is actually the challenge that the central bank has, right? uh, See, under these conditions, the first challenge is delivering the medium term inflation aim is to reconnect inflation to its pre-pandemic project path. So always that there is that pandemic, the pre-pandemic project path means that it was actually the mm, uh, rate or the path that we have given, we have expected, and also we have given to the public through the forward guidances, right? So international central banking, it is another point. But here you can understand that whatever the measures, monetary policy measures that have been taken by the central bank, they have to time adjust their policy path to come into the pre-pandemic projected path, where it is actually the normal situation, right? But this is a crisis situation. At the end of the crisis, that the economy should be at that original path, or else that is basically the inflation, right? But otherwise, now that we know that with the many of the policy measures that we have taken, more and more liquidity they are in the market. But in the short run, that we know that economy is not going to boost at that speed. But when the economy is started to recover, what will happen? That all this liquidity in the market now at the moment, that because of the uncertainty, people are not going to be that much of active, and also not going to be taken their decisions. But at the time being, that they are started to consume, invest and all that, when they are going to be activate, that they are going to use that liquidity, right? So what will happen? That aggregate demand is, it will push up and up. At that time, that the real sector has not been developed at the same magnitudes. That means that not to the level that liquidity is there. What will happen? That the aggregate supply is not adequate enough to meet the aggregate demand, so that there can be a very big inflationary pressure in the economy. So it is one challenging aspects that central banks to think of in the future, because of that the current policy measures that we are implementing a very easing monetary policy mechanism. But when the economy is recover, there can be an inflationary pressure. Okay, and also the another thing is, when the economy is started to activate, that gradually the central bank has to start implementing a contradictory monetary policy measures, that in this tighten monetary policy to absorb those liquidity in a very gradual manner, to absorb again that excess liquidity in the market. Here that the target is actually, that challenging part is actually that to maintain the inflation as well as the output growth, so that the liquidity should be there to encourage the economic activities, so the growth rate. But at the same time, that the projected level of inflation is also there. We have to stabilize the price levels as well. So that is the two type of things that the central bank has to have the balance, right? So at the time that the correct time, that central bank has to implement the tightened monetary policy as well, right? And so that is there. So, but that now we are having the easing monetary policy, but with the liquidity, that the growth momentum has been increased to the potential level, means that it doesn't uh, matter for inflation, because that at the time that aggregate demand increases, the aggregate supply is increasing, that then it is all right. But if it is not happening, then central bank has to uh, control the situation, right? So this is the two way that the central bank has to take the further macroeconomic monetary policy decisions. The international central banking community has always been urged to learn from past developments and experiences. Also, with respect to different experiences across countries, with the belief that the future is always uncertain, and preparedness for crisis need to be central element of the monetary policy. That is there. It is an obvious fact that, not like in the early stages, now that always that central bank has a very challenging role to play. Always need to uh, have that preparedness. However, these measures have to be seen by market participants as the results of an autonomous decision by the central bank, right? So that always that outside or the economic uh, agents, that they should, so these policy measures are so independent. So then that's why, that's how they are going to keep confidence on the policy guidance given by the central bank, or else that it is not going to work. These crises have demonstrated that the monetary policy aim at fine tuning short term objectives, right? Crisis, serious risk. Short term orientation could have negative side effects in the medium to long term. That's what we already discussed. That normally these measures that we have introduced during the pandemic crisis is actually with the short term objective to recover, to boost the economy. But these short term oriented uh, policy measures, that it gives, that there are some negative side effects, as I mentioned you already. So that and also it will give bad effects on the medium or the long term, that prospects that we have. These side effects manifested themselves in a speculator build-up of monetary and financial imbalance. That's what we already discussed. That always that I already described you how the expectations work, and with those expectations, that future always creates based on the current expectations. So that's why it is very difficult task has been given to the central bank. It is more and more challenging because of this crisis situation, but it is the responsibility the central bank has. The effectiveness of monetary policy on the basis of institutional and operational independence was, however, fundamental during the crisis. We already discussed in one session about the operational and institutional independence of the central bank. Here, when the central bank is implementing these type of monetary policies, now we can understand uh, the effectiveness of the monetary policy. It is basically based on that level of independence, right? And especially it is a fundamental thing during the crisis as well, or otherwise that uh, the economic agents are not going to the have that confidence on the policy measures taken by the central bank, so that they are not going to react to these measures, so that it will not work. So that's what can happen. Okay, that's what I want to discuss today under this session. So we discuss about the trends and issues that the current central banks are facing, giving emphasis on the pandemic crisis that we are experiencing today. And also we discuss about the policy measures have been taken by the Fed system and also the European Central Banks. But going beyond, I advise you to read about the policy measures have been taken by the other leading central banks around the world, which we have already been identified during the last sessions. And also, I will share the measures taken by the Central Bank of Sri Lanka. Okay, thank you so much.